This is the time where we focus on a personal finance corner. Harsh Roongta of Apnapaisa.com joins in. Hi Harsh, good afternoon.
Hello.
Let me straight away go across to our first caller. Rohan Singh has called us from Mumbai. Hi Rohan.
Hi. My question for Mr. Roongta is what are the pros and cons of investing in debt funds?
Okay. So, debt funds are a family of funds. There are various kinds of funds. You have liquid or ultra short term funds, you have income funds, you have fixed maturity plans. Let me quickly list down the pros and cons. One, obviously, when you're looking at debt funds, you're looking, I suspect, relative to fixed deposits. I mean, as alternative to fixed deposits or possibly debentures. And I think as an alternative, each of these funds have certain advantages and disadvantages. In terms of returns, I think the pros are that post-tax returns on, if you want to hold on for more than a year, then the tax treatment ensures that the post-tax returns are better than a fixed deposit, because if you take the growth option, typically these will get taxed as a long-term capital gain post 1 year. And even if it gets taxed as a short-term gain, the tax treatment will ensure that you have a slightly better yield from the mutual funds. The second advantage of mutual funds is that you can have an indeterminate period. When you do fixed deposits, you will have to decide in advance what the period is. Post that, if you still need to reinvest, that will happen at that rate. Here the exit costs in say for example the ultra short term or liquid is very low. In the other funds, if you hold them for a year, again they are not very large. So essentially the pros are better post-tax return if you hold them for more than a year. The liquidity costs are not very high. Disadvantages are, I think the returns are obviously not fixed, unlike a fixed deposit. There could be fluctuations in the value NAV because of the interest rate fluctuations. Now, because interest rates have been so volatile, we have seen even in liquid funds some amount of NAV fluctuations. Most important, I think, which is underplayed, is that if there are large scale credit losses, and given the state of the economy, those can't really be ruled out. Although the mutual fund industry hasn't really seen any major credit losses. So I think given all that, I think on the balance, it is a pretty good investment.
All right. We also have a quick SMS query also coming in, so let's quickly address that. It's an SMS query from Ria Rastogi, who has written to us from Kolkata. She says she is a freelance professional and can pay 5,000 rupees per month premium for an insurance policy and can scale this up to 8,000 rupees per month if required. She will need the accumulated funds at the end of 10 years and hence needs advice.
So I think the good thing is that she is planning so much in advance. I think the not so good thing is that she is looking at insurance as an investment. I think insurance and investment together are not really words that go well together. She should look at her insurance separately. For this investment, since she has a 10-year horizon, would recommend systematic investment in large cap funds. She can look at even an index fund, something like a Franklin India Nifty index fund, or for some of the amount she can look at another large cap fund like ICICI Pru Focus Blue Chip Fund. Don't invest in insurance. For your investment needs, especially since it is long term, it's much better to do large cap equity funds.
Alright Harsh, thanks so much for all those details. Reliance Communications stock should be up for your screen. It's reacting a bit negatively. It's a CNBC TV 18 exclusive that the stake sale of the DTH business of Reliance Communication, we understand, has been called off. Stock is off from a little bit, at least, from the earlier morning high.